As the 75th Secretary of the Treasury, Timothy Geithner played a central role in formulating U.S. domestic and international policy during President Barack Obama's first term. He was a principal architect of the president's strategy to avert economic collapse and to reform the financial system, while also tackling a broad set of international economic challenges. Between 2003 and 2009, Mr. Geithner served as President and Chief Executive Officer of the Federal Reserve Bank of New York. He first joined the Treasury Department in 1988 and held a number of positions in 3 administrations, including Undersecretary for International Affairs under Secretaries Robert Rubin and Lawrence Summers. Mr. Geithner is currently president of Warburg Pincus and is here tonight with his new book, Stress Test: Reflections on Financial Crises, and all of you have received a copy of that book. Appearing in conversation this evening with Timothy Geithner is Dr. Laura DeAndrea Tyson, professor and director of the Institute for Business and Social Impact at the Haas School of Business at the University of California, Berkeley. A member of President Obama's Economic Recovery Advisory Board, Dr. Tyson served in the Clinton administration, was the chair of the Council of Economic Advisors from 1993 to 1995, and was the president's National Economic Advisor. Please join me in welcoming Timothy Geithner and Laura Tyson.
Good evening, everyone. Tim, I want to start a little bit with who you really are. I think the book is a wonderful book, and it's a wonderful book about all the policy, but it's also a wonderful book about Tim and who he really is. And there are some misunderstandings about you. One is that you're a lifer on Wall Street, a creation of Wall Street. You just went to the government to defend Wall Street. Another misunderstanding you had with Barbra Streisand, one of your big fans, and I want you to tell the group about that misunderstanding of who you are.
I don't think she's really such a big fan. I was at a state dinner, and she came up to me and said, "I've been watching you, and I don't think you're really telling us everything. But you know, because you're a Jew from Brooklyn, you're probably okay." Neither of those two things were true, but it was still nice. It was still nice to be to be perceived that way.
It shows you how perceptions of one in Washington can be quite different from reality. Neither a Jew nor from Brooklyn. I believe you've written a terrific book, and in the book, one of the things you say about yourself, you fault your inability to communicate. You say, "I couldn't communicate," and you give a very funny anecdote about giving a speech. But this is a really wonderful communication. So for those of you who want to be communicated to about the causes and responses to the crisis, it's a great piece of work. I want to start with the causes a little bit. So when you hear about the financial crisis of 2007-08, people say things like it was caused by greed, it was caused by crime, it was caused by lax regulation. What were the causes in your view?
Well, there was enough in this mess to support really any theory of financial crises. You know, there was terrible abuse and predation. There was substantial regulatory failure. There was a lot of moral hazard, a lot of bad incentive problems. There was a lot there that mattered. But the most important thing in this crisis is, I think, still not that well accepted, which is, like in any massive financial crisis, this was preceded by a long period of really excess confidence that the future would be stable, that it would be safe to lend a huge amount of money, take on a lot of leverage, borrow a lot of money relative to income. And that belief that recessions would be short and shallow, that house prices would never fall, that belief, which hardened over time, you know, we lost the memory of crisis, that ended up supporting a really massive financial boom. And that's what happens before all great financial crises and panics. But in our country, it was made worse by the fact that so much of that risk ended up outside the safeguards we put around the banking system after the Great Depression. So after the Great Depression, we put constraints on risk-taking on banks, and we built in these protections against panics, deposit insurance being the most important of those things. But in the decades that followed, we innovated in the United States all sorts of other institutions.
Right.
Money market funds, a bunch of fancy financing vehicles, and a bunch of large institutions that became very leveraged, very risky. Investment banks being one of them, but also some big insurance companies, GE Capital, a bunch of non-bank finance companies, AIG, Fannie Freddie. So by 2007, that late stage of the boom, that parallel banking system was larger than the traditional banking system. But there were no really meaningful constraints on leverage in that system. And more importantly, there was no existing set of protections, established protections against runs and panics. So that made it much more dangerous, much harder to solve. That's why when the fire started burning in August of 2007, it ended up getting, gradually over time, just got a huge amount of force and momentum. So that's my view. And I think, my view of this is, it's informed a lot by what these great economists, Charles Kinderberger and Hyman Minsky, wrote about financial crises. It's a recurring pattern. It doesn't happen, the severe ones don't happen that often, because in some ways you have to lose the memory of crisis to be vulnerable to a crisis like that. And of course, for the United States, it's really the Great Depression was our last real experience.
Right, right. It certainly was the case that you mentioned the view out there that our recessions were going to be mild. I have to confess, my profession of economist was not helping out here at all, because we had developed theories that markets were rational, and therefore, because they were rational, they could self-regulate. And we also had in mind, well, if something goes wrong, we actually know what to do. There are mild recessions, and the Fed will just come in and make a little adjustment. So we had this thing about the great moderation. So this led people on the financial markets, it fed into their super optimism, their over optimism.
Well, don't take the responsibility yourself, because the markets normally pay no attention to economists.
Okay.
They just developed that belief on their own.
All right, well, that's good to know. I'm very relieved, thank you. So you were sitting there as the chair of the New York Fed. Why didn't you see this coming? Or when did you see it coming, and did you say, oh my God, it's coming, there's nothing I can do?
Well, I write a lot about, I try to write honestly, candidly, about all the things we missed and we saw, we're worried about. And, my dominant, let's say, fear when I got to the New York Fed in the fall of 2003 was this basic mismatch that existed then between where the risk was and where there was an accountable authority for containing that risk and the scope of the tools we had to prevent panics. So the New York Fed, of course, is really the lender of last resort to our system. But the Fed's authority, of course, at that point only applied to a pretty small fraction of finance. And the tools we had to prevent runs from escalating were pretty limited. And so I was deeply worried about this. I write about how I when I got there and they started to trust me, they showed me this thing they called the Doomsday Book, which was a thick binder of authority that we're supposed to be able to deploy if things fell apart. And it was terrifying, because when I went through that, it was what you said, Laura. There was just sort of more like, the Fed would stand up and say, we're going to make liquidity available to markets.
Right.
It's like fairy dust. The real powers the Fed had were very limited against a massive panic. So we had this basic challenge, which is we had to figure out a way to try to lean against the risk that was being built up across the system, not just in banks. And we had this, just one example, we had a derivatives market, which of course was, exploding in size, completely untested by crisis, really, and had an infrastructure that was, it was kind of, spreadsheets and fax machines and pencils. very weak. So we try to do a set of things, and they were actually quite valuable in reducing some of the vulnerability, but they were nothing close to what was necessary. And there was nothing we could do was powerful enough to offset those forces of confidence that created this conditions. I mean, remember, these were private markets. They were willingly financing huge amounts of leverage across the system.
Yes, there were huge amounts of leverage, and the other thing that's true at that time is that much remarked that the rest of the world was searching for return, and a huge amount. I remember the Fed at a certain point started to worry too, and they said, well, one way to cool this all down is to raise interest rates. So they started to raise interest rates, but they couldn't get the long rates to go up. They wouldn't go up. The Fed only controls short rates. So why wouldn't the long rates go up? Because the whole rest of the world was saying, well, we'll buy all this stuff. We love this stuff. So it really was the tools just weren't there. Well, let's go now to something that always comes up.
Can I just let's just say this is an important thing.
Yeah, sure.
What the history of finance tells us, it's sort of a tragic thing, but it's a very useful lesson, is that these things, they really can't be anticipated, and they clearly can't be preempted. So you can't design a system that rests on the premise that you can have a bunch of people in Washington or New York sitting there looking at their over the horizon radar and say, okay, we see that crisis coming, we're just going to preempt it. It's not the way finance works. But you can do a lot of things to make them less damaging, both in terms of, we're going to come to this, I'm sure, what you do to make the system a little less vulnerable, but also how you equip governments to respond more forcefully when things happen. But you want to design a system that recognizes that the future is inherently uncertain and basically unpredictable. And you want to run a system that's not vulnerable to these deep failures of imagination that humans are vulnerable to, because again, if you lose the memory of panics and you assume they're not plausible, it makes you vulnerable. But there are ways to do that. It's not beyond our capacity. I try to explain what we think has the most promise in those reforms.
But I'll jump right to that point, because one of the things that critics of the book have said is, well, what he says, what Secretary Geithner says is, we've put in more protections, we've reduced the risk of one of these crises, but then you say, but we've taken away too much of the weapons to fight a crisis if it occurs. So it's sort of like saying, we reduce the probability of the fire, but if the fire starts, we have fewer fire engines.
Exactly right.
That's an amazing observation. So
it's unfortunate, and it's sort of contrary to conventional wisdom, because, again, I want to be fair to the debate. There are a lot of people that believe that in finance, fire stations cause fires, or that you make fires less likely to happen if you lock the doors of the fire station. It's just not the way finance works. It'd be nice if that were the case. And there's a deep conviction people have that you can design a system that can prevent fires from breaking out. But you can be completely at the frontier of what's possible in terms of capital requirements and shock absorbers and funding and limitations on risk and all that stuff. You get all stuff really cool and perfect. But it will not make you invulnerable to panics. So what you need is a combination of those shock absorbers, reforms, constraints on risk, which we've made dramatically more conservative, but you're still going to need the fire station, the panic. If you look at the history of bank runs, what countries used to do to break them is they'd pile a bunch of gold in the window or silver in the window, so people could see there was resources there vastly disproportionate to the deposits that could run, and often that was effective in stemming a panic.
I see. Right.
So you can have a lot of capital, but still have a whole bunch of runnable stuff. So to protect people from the risk of the calamities that happen in panics, you have to have a fire station willing to deploy a massive amount of force so you reduce the incentive to run. You can't design a system where you don't need that. And it's quixotic and misguided to try to do it.
So one of the examples, I think, of where we didn't have an ability, or you didn't have an ability to take an action, which then became a devastatingly destabilizing action, was Lehman itself. And you say you regret that, but that there was really nothing that could be done, demonstrating that in a crisis you having some instruments. But so I have a question about that, because a couple of weeks after Lehman, there was another decision made, and the decision was when Lehman failed, there was a widespread view immediately, absolutely immediately, that that was the end of all investment banks. And it didn't matter whether you were Goldman Sachs or Morgan Stanley, sort of reasonably well-capitalized ones, they were all going down. Okay, that was the general view, because there's a run now on the entire system because you saw that one of them went bankrupt in a very disorderly way. But then the decision was made to actually work with those two remaining ones to make them banks. Now, why didn't that happen with Lehman? Why did it happen here?
Well, let's do a little history. Bear Stearns was really the first one to lose the ability to stand on its own. And then the force of that storm gained momentum over the course of the summer. And by that time, what people call Lehman weekend, Lehman and Merrill Lynch were at the edge of failure, not just AIG. Right. And you're right to say if they had failed, all of them had failed. And even with B of A's purchase of Merrill Lynch, the run on the rest of the system accelerated. Right. So at that point, there were these two investment banks left standing, Goldman Sachs and Merrill Lynch. Morgan Stanley and Merrill Lynch, and Morgan Stanley and Goldman, sorry. And they were definitely the strongest franchises. Much stronger than the three who had failed, lost the chance to stand alone. And what we did, and we tried some other things too, as you may remember, but we had no good options. What we did is, in the end, we went to the leadership of those two institutions and said, if you go raise a bunch of capital, outside capital, we'll make you bank holding companies. And the combination of the infusion of capital by Buffett in the Goldman context and by Japanese Bank in the Morgan Stanley context, which was made attractive in some ways because of the bank holding company status, bought those two institutions a measure, but just a measure of stability. Because even after that act, the system was still, kind of crumbling around us, and it took the much greater guarantees and a very substantial, forceful injection of capital by the government to break the panic in October of 2000.
So now let's go to the forceful injection of capital, because that's really where you get the bailout concept. All right, so the bailout, in the case of Lehman, they failed. Private money came into Goldman and Morgan Stanley. But clearly there was a sense that the whole system was still very fragile, and you had to get capital into the system. So you bring these bankers together and you'd say, you're going to take this amount of money. And these are big sums of money. You're going to take 25 billion, you're going to take 15, you're going to take 10. Here are the conditions. Explain that. I mean, that to people is really partly the essence of the concern about bailout. You bailed them out, you did it on good terms, it wasn't a high borrowing rate, no real conditions on their behavior that were significant. So why? Why did you do it with weak conditions?
Well, in a financial panic, which is completely different from a typical financial crisis, the only way to prevent the risk of mass unemployment, like we saw in the Great Depression, decade of shanty towns and soup lines, is to make sure you stabilize the system, prevent the lights from going out. We don't like to admit it, but economies can't function without a functioning financial system. If people can't borrow, if the risk is they're going to lose all the savings in banks, that brings economies to the edge of collapse. And it's not a theoretical thing. It happened in the Great Depression. It happened in a bunch of emerging market economies even in the 90s. And it happened in the 50 years before the Great Depression with periodic, Great Depressions following panics. So the only way you can protect the responsible business, the responsible part of the financial system, the responsible borrower from the calamity of a panic like that is to make sure you step in and prevent collapse. You don't do it because, it's a deeply offensive thing to do. It's deeply counterintuitive, but it's the responsible moral thing to do in a panic, because if you don't do it, you risk it's not really a risk, because you face the certainty of just much worse outcomes. So at that time, as you guys remember, at that time the system was just collapsing around us, all around the world.
It was collapsing.
It's like it was like we were over the edge of the cliff, and the economies around the world were grinding to a halt, and the run on the financial system was accelerating, and it had moved from investment banks to banks.
To banks. It moved to banks.
So what we did was put together a mix of guarantees by the FDIC and the forceful injection of capital, which together, and it wouldn't have worked with, it might have worked with guarantees, but it wouldn't have worked just with capital, were powerful enough to break not to arrest completely, but to break the momentum of the panic. And at that point, it was like the plane was burning, and the cabin was filling with smoke, and we had no time.
No time.
And we thought, and I believe this was the right judgment, is we thought that the first obligation we had was to land that plane safely. And we had a lot of innocent victims on the plane, and we had a lot of banks and investors on the plane, and once we landed the plane, we were just trying to figure out how to clean up the mess and figure out how to fix the system, make it less vulnerable. But you couldn't do all those things
At once.
In the midst of that panic. There was just no time. And I know people ask this question. They say, "Well, yeah, but it was so generous."
It was so generous. I think John Stewart said you got the arsonists off the plane, and then you served dinner.
Gave them a massage.
You gave them dinner and a massage.
They did, yeah, that's right.
Right.
Yeah.
So that's a nice capture of the criticism right there.
Of course, the banks. It's sort of interesting. The banks kind of think we were, we were just a bunch of crazy socialists ending capitalism. They thought it was a deeply unfair act, deeply unfair.
That's right.
And they wanted the guarantees. They didn't want the capital, because the capital was going to dilute their shareholders on a very massive scale, which it did in proportion to the risk they took.
Absolutely did.
Now, it's not quite the way it's perceived still. I think most people still think that the government went in and wrote a bunch of checks for free to the financial system on a massive scale, money we'd never see again.
Right.
And that's not what we did. What we did is design a set of capital injections and guarantees, which we provided for a price.
The price. Could maybe got a little higher price, but
maybe, but well, Laura, you know this. In March '09,
I know.
The consensus among many smart economists was that we were going to lose $2 trillion.
I know.
So we're going to earn a modest profit for the taxpayer.
Right.
We got the economy growing in 6 months, and the people who thought we were going to lose $2 trillion at that point, they thought there was no realistic prospect ever that we'd see a penny of that stuff back. And so they can say now, today, if they want, we could have designed it with a higher return, deeply implausible.
Right.
I mean, the S&L crisis was a tiny little financial thing, and it cost 3.5% of GDP to clean that up. 3.5% of GDP, in current dollars is, it's almost $500 billion. So to have turned a $2 trillion loss into a $100 billion modest profit is a material accomplishment. It's not the best measure of the success of what we did, because, of course, we're not able to prevent a huge amount of damage.
No.
And we're still living with the scars of this. And it was a messy, horrible thing, but not fairly characterized as an avoidable, unjust, unconditional gift to institutions that you could have let collapse without risk of mass unemployment.
Certainly the numbers at the time all of this was happening, if you looked at, as an economist at the numbers, you did see the same trends or worse trends in real economic activity around the world that you saw in 1929. This was no kidding around. This was really looking into the abyss in the real economy side. So you were trying to sort of deal with the financial side in order to keep the real economy going.
I think people we'd like to live in a world where you can be indifferent all the time to financial failure in the system, but it's not possible. No. And again, even in early September, people thought what was happening in finance was a just and welcome thing. A kind of good moral retribution for a bunch of excess behavior, and which was understandable. But people were pretty certain, even in September, that this would have no effect on the average person.
Yes, they were.
It wasn't going to touch us. Wasn't going to hurt us.
Right.
And that's because you still couldn't really see the pain. It was coming. But you know the story. That size of that financial shock in the fall of 2008, in terms of lost wealth, expected default of businesses, was 5 times larger than at the beginning of the Great Depression.
Yeah. Yeah.
So it wasn't like a theoretical, implausible risk that we were facing. A set of outcomes could have been worse than the Great Depression. It was the reality at the time.
So troubled asset recovery program, that was the capital infusion. You get to Washington then, so this is happening during the time you're the Fed, New York Fed chair. You get to Washington, you're becoming the Treasury Secretary. There's about half of that money left, or a little less. The crisis, as you said, has gotten, you've mitigated, you've slowed it down, but there's still there's a huge amount of bad assets in the system, clogging the system up, and private capital is staying away from financial institutions. So I love this story because it suggests we should all go on vacation and meditate occasionally. Tim manages, I don't know exactly when, to go to Mexico with his family. And while he's there, he comes up with what it will probably be when history looks back on all of this, the defining moment, the moment when we absolutely stopped this, was not the capital infusion and not the guarantees, but the next step, which was the stress tests.
That's the title of my book.
And that's why, and it is correctly the title of the book. It's correctly the title of the book, because it was Timothy's idea, and it was a very high-risk idea. So this is the idea: you're going to go in and do these tests. You're going to determine which banks have adequate capital provisions and which don't. Now, here's the risk. If everybody passes, are people going to believe you? Maybe this stress test was just made up, was too weak. If everybody fails, oh my God, more and more capital needs to be supplied. Maybe the government should nationalize the banks, maybe. So tell me how the stress tests, why did they work so well? What brilliance came to give us this terrific outcome?
Well, two things of context that are worth noting. Among the things we tried and missed and got wrong in the boom at the New York Fed was we did some early experimentation with stress testing as a device.
Okay.
And found that we could get no traction because, the toughest tests that the firms in New York were applying to themselves around the world was, didn't produce losses more than a quarter's earnings. They weren't very, they weren't very stressful.
They weren't very stressful.
And we were trying to figure out how to make them tougher, but never got enough traction. But we had a lot of experience in failure. That was very helpful.
Okay.
It was a good intellectual foundation for the exercise. And then in January of 2009, it's true that we'd slowed the momentum of the panic, but the system was totally frozen, and the economy was falling off the cliff. It was contracting at an 8% annual rate. So the shocks to the average business, average household, were at that point, still gaining momentum. So we had to figure out, okay, what would be the next stage of the strategy? And I'm coming to the stress testing, but I want to point out that what we did was a massive fiscal stimulus program, which was, although not enough and not sustained long enough, was larger than what Roosevelt did in the Great Depression in relative terms. We had an incredibly brave, creative central banker in Bernanke who was changing the frontiers of central banking. And then we did some pretty novel things to get the credit markets that were not banks reopened. And they worked. They were like flipping a switch. They worked so successfully. You could borrow to buy a car again after not being possible to do that. But in the banking system was still viewed as deeply undercapitalized, and nobody had any feeling for how much more capital they might need.
Okay, right.
And we did something which is a little bit similar to what Roosevelt did in the Great Depression. What Roosevelt did is he took a sort of firestorm of state-by-state bank holidays, made it a national holiday, closed them all, and then they spent a few days and weeks trying to separate the viable from the non-viable, reopened the viable. And that bought them a little measure of.
Okay.
So what we decided to do was to impose a stress test on these banks. What that meant is we said that what we're going to say is if we face a Great Depression, like loss of GDP and employment, and you will experience this level of losses, we're going to disclose those losses so everybody can see them, fully transparent, and we're going to give you 6 months to go raise capital. So you can survive even in the event you face those losses. And if you can't raise that capital, we're going to put another big dose of public capital in you, whether you like it or not.
Right, whether you like it or not.
So that what we try to do is maximize the chance that this mix of transparency and rigor in the test would give us the chance to see whether we could get private capital to come and do this so the taxpayer wouldn't have to do it. And we gave the responsibility of design to the Fed because they were the most independent of pressure body out there to do it, and they did an excellent job. And I'll show you this little thing. I want to show you this little picture which shows how they got it right.
How they got it right? Okay.
Yeah, I'm going to show you a little picture. And you'll be able to see it, don't worry. It's like a very important picture, and it's in my book.
Okay.
So I'll just draw you a picture, and this is a picture of 100 years of losses in the American financial system. And so I'll show you what it looks like. It has this big, huge thing, I'm going to show this to you in a sec, of the Great Depression. It shows like a foothills, it's like the Himalayas. Right. It shows like the foothills of the Appalachia a bunch of times, and then you have this crisis. So that's the loss, that's what it looks like, history. And what the Fed did is say, okay, we're going to draw the line here.
Right, they did
above
do that. We're going to make
above
it,
that,
right.
That's what it is.
That's right.
So the morning, I write in my book about how the morning the stress tests were released, I think one of the best sources of research in finance is a hedge fund named Bridgewater. Very skeptical, very dark at that time. They put out their daily thing and said, we agree. So what happened was they looked at the details of it and they said, that's pretty credible. It matches our estimates of how bad things could be if things really fall apart. And it's transparent enough we can see it. And it was like, it happened so quickly. The world went and put capital in those institutions
they did.
on a very dramatic scale, and on a scale that allowed us to get the taxpayer repaid and still leave these institutions with much more capital. So it was, but it only worked because the fiscal stimulus at that point was getting some traction. The monetary policy experimentation of the Fed was getting some traction. The scale of things we did, we were doing unlimited swap lines to the world at that point, the Fed was. The scale of things we did there globally and in the other credit markets was starting to get traction. And together, they started to allow people to feel like, gee, we might get through this. And then that, panic being feeding on itself, then we had a thing where things churned and the confidence became a little self-reinforcing, and the economy went, started growing again in 6 months.
In 6 months, right.
I mean, incredibly quickly, given again, people were still saying in March that we were going to lose trillions and it was going to be a Great Depression. So very, very quick turnaround in that case. But of course, it came late. The fiscal stimulus came late. The massive escalation of the financial rescue came late because we didn't have the authority. And so the damage to the economy already had tragic momentum and was going to cause, at that point it was baked in, was going to cause the recession much worse than anything we'd seen,
Okay, so let's now, much of the tragic momentum ended up for individual lives being in terms of foreclosures and underwater mortgages. Job loss, complete also, and the fiscal stimulus and the easy monetary policy and the stress test, all of those things were helping to mitigate the extent of job loss. They certainly were. I mean, Alan Blinder's estimate is just in those early months, you saved something like 8.5 million jobs worse that would have been lost, okay, in addition to all the ones that were already being lost. It was up to almost 10% unemployment at that point, and it could have been substantially worse. So really, a lot was done, but part of the harm that has been ongoing, of course, has been in the housing market. So, and obviously a very common criticism of the administration and of the Treasury is, okay, you figured out a successful way, and let's say it's successful to bail out the banks. It worked, it slowed the institution. You didn't use all the TARP money. There was plenty of TARP money left. So why not help the households out? These poor foreclosures and underwater mortgages. And I have to say, one of the things, I don't know if you read this, but Alan Binder says, on this question, you were like Hamlet. You were like Hamlet, to be or not to be, to address that problem or not to address that problem. How much should I address that problem? So talk a little bit about why we weren't able to do more.
Well, let me just start by saying that obviously the things we did in housing were, just terribly small and late relative to the scale of the damage. Mm-hmm. And it was terrible. And deeply frustrating, and terribly frustrating for the President of the United States, who, had the right incentives, was worried about it, and he would take home these letters. He used to take home a bunch of letters every night, and overwhelmingly there were people who were going to lose their house, and they made you cry. And he would put relentless pressure on us to maximize what we could do. So let me just explain a little bit why they were so limited in power. Right. It was not because we did not understand how terrible it was. Mm-hmm. It was not because the president did not have around him people who knew stuff about housing. He had, I think, some of the best talent on housing in the country, practitioner talent like Sean Donovan, and academic talent like Michael Barr is a good example. Yeah. He had a bunch of progressive economists around him. Mm-hmm. There was a huge political imperative to do as much as you could. Yeah. But we had a set of constraints on our authority and our resources that made the available solutions to us very limited relative to the scale of the problem. And we were unable to relax those constraints. He tried twice to pass bankruptcy reform, which may have made some modest difference. When he had Democratic majorities in both houses, unsuccessful. We proposed a series of expansions of authority to get more resources and more power, which Congress was unwilling to act on. We tried to get, I came a little late to this conviction, but not too late, that we should add a more forceful principal reduction program to our initial programs. We went to Fannie and Freddie and their overseer, tried to get them to do it, laid out the case for doing it. They would not do it. We could not force them to do it. So, and it's true that even where we had authority, our programs, even though we kept expanding them, kept making them more generous, kept adding new pieces to it, we just didn't, we just couldn't do it fast enough. Mm-hmm. But it was overwhelmingly because of the constraints, not because we didn't have a lot of talented people focused on it. And I try to ask the question from a different way. Yeah, we had demonstrated a huge amount of creativity and force on the financial rescue. But the authority we had, because we had the TARP resources, we had the FDIC's guarantee authority, we had the Fed's massive balance sheet resources, we were able to do that creative thing because we had vastly greater authority after Congress gave us legislation. In housing, we had a tiny bit of authority relative to the problem, and we tried to get to the frontier, but it just wasn't enough.
Okay. One other thing before we go on to reforms. One view would be, okay, you stabilized everything. You did as much as you could in banking. Once it was stabilized, why didn't you just go after some of the big banks? So this is the too big to fail argument. People say, oh God, you stabilized the system, and we got these mega banks now, and they're going to do the same thing. Why didn't you break them up? And you have this wonderful line in there that from the point of view of the regulators and from the economists, breaking up big banks was like a Moby Dick, quixotic sort of, I think you say misguided and quixotic goal. Why? Why is that a quixotic and misguided goal?
This basic concern about too big to fail moral hazard, it's central to all financial systems. You should always worry about it. You should never, it'll never, it's like the forever war.
Okay.
But you have to ask yourself this basic question: what was going to be the most effective way to make the system more resilient? What was going to be the most effective way to allow us to be closer to the point where we could be indifferent to their mistakes and to their failure? That's the system we want to design. And Paul Krugman likes to remind people, it was very helpful, that the Great Depression was a financial panic, financial crisis in a very atomized system of overwhelmingly small banks. So it's important to recognize that this thing about size and risk is just much more complicated than people think. And our view, and I'm very confident this is right, our view is the most effective strategy and the most achievable strategy was to do a different mix of limits on size and forced constraints on leverage with capital. Because capital is the best way to make them able to absorb much greater losses. And if the big ones fail, much more likely for the rest of the system to survive because they have more resources against the contagion in that context. We did put in place a set of limits in our system that are much tougher limits than exist anywhere on the planet. In our system, banks through acquisition can't be more than 10% of the banking system. Now you could say, well, 10% seems like a lot, but look at Japan, look at Canada, look at Switzerland, look at the UK, look at Germany, look at France. Those are dramatically more concentrated systems. And in our system, banks are only about half of credit. Whereas in those other countries, they're about 80% of credit. And in their systems, their banks as a whole are much, much larger as a share of their economies. Again, our country, we think our banks are too big. We worry about that. But it's the relative thing that matters. In our country, our banks and investment banks are about 1 times GDP. In the UK and Switzerland, it's more like 5 to 8 times GDP. In Canada, it's more like 2 times GDP. Right. France, it's more like 3 times GDP. So we are much closer to the point, and much closer to the point that we were in 2007, the decade before that, and much more so than any other country in a major economy, where we are much closer to being able to say we can be indifferent to the risk of failure among individual institutions. But you should always worry about it, always keep at it. But it wasn't that we're not worried about moral hazard or worried about risk. We just sort of thought that the most effective and the most likely achievable strategy was that set of limits on risk, shock absorbers, safeguards, rather than trying to, remember, Bear Stearns and Lehman were not very big. Right. They were in that midst of that fire, they were catastrophic.
Right. So this, you're talking about shock absorbers, capital ratio changes, liquidity constraints. So this gets us to financial reform. There are a number of questions here. And I guess I would say, based on your experience of the crisis, what were the reforms that were needed, and did we get most of what we needed? Okay, so you're saying we're better off than the rest of the world in terms of, say, size of banks, but maybe we still don't have enough. So how do you feel about what we needed, and did we get it?
Okay, let me just highlight the things that I think are most important in this messy and imperfect set of reforms. We have a much better design, much more comprehensive set of consumer protections, significantly to the credit of Elizabeth Warren. Took a Wild West of atomized, dark, pretty bad abuse, prone to abuse, predation stuff, and have a much cleaner set of authority, much more broadly applied. That's very important. We have better tools for managing failure of large institutions. Bankruptcy for large dumb banks, somebody called it once. Didn't have it for Lehman, AIG, Bear Stearns, Merrill Lynch.
Didn't have it, no.
In the crisis. Better set of tools today for that. We have this authority to set limits on risk across the system on a much broader scale we didn't have before the crisis. And those limits, those constraints on capital, are probably 3 times more conservative than they were before the crisis. And with stress testing, also the title of my book,
they're ongoing. They haven't never stopped. There's stress tests every year now.
They are.
So.
I mean, you're being tortured all the time.
That's
for this
right.
stuff.
Stress tests every year.
But it's a much more conservative regime. Now, and we have as you're seeing, we have a better financed, with better set of rules, enforcement deterrent than we had in place before the crisis. Not done yet, not completely proven yet, but better financed and better rules in that context. As we discussed a few minutes ago, we lost some of the firefighting tools we had because of this belief, this little fever of belief that fire stations cause fires. But I think on balance still, the net of those things, even with the slightly weaker firefighting tools, is definitely a more stable system, a safer system than it was in the decades before the crisis. And you're right to say that just because our system is better designed, and I think it is better designed than those of many other countries, and we're much less concentrated system, much smaller banking system than in other countries, that's not the right standard for us. Our standard should be, but is it strong enough for us now? Mm-hmm. And I think that it's something you should always worry about. And you should worry most when people claim too much for what's been produced, because finance is inherently risky, and over time, risk will find its way around these constraints, right, and leave us at the risk of panic again.
But I think what's really comes across to my mind in a is your overall assessment of what's been done is quite positive, and you confess this at the end of the book. It's amazing that in this highly fraught and increasingly fraught political environment, we actually got a lot of the reforms that make sense. It's really quite remarkable, because the sausage making itself process was terrible.
Oh, it was terrible. Like, I tell a story about how, we would go up to the Hill to try to, find a coalition to pass these things. And, I tell a story about a Republican senator who said to me, I want to be with you on this stuff. I want to be for the financial reforms, but there's two banks in my state that you got to protect. And then you had progressive Democrats who said, I want to be for tough reforms. I believe in this stuff, but they can't be designed so they apply to these two industries in my state. So you had a general view that reform was important, but not a huge amount of conviction that it should be strong enough to affect the economics of banking.
And by the way, I think that's going on right now in terms of discussions about what to do with the money market funds, because you mentioned that. Example, yeah. So one of the things that has not been changed in the system, big non-bank institutions, money market funds, and they are waging a very strong campaign not to be viewed as systemically significant. So.
Yeah, again, one reason why this crisis was so damaging is because in our country, we allow a lot of institutions to do what's effectively banking, mm-hmm, without being regulated as banks, with no capital requirements, none of the constraints that exist for banks. And money market funds were built up to take advantage of that regulatory arbitrage, and they built up huge franchise value, and they're willing to spend a lot of money to protect that. And that's something you should always worry about and keep trying to figure out how to break the politics of that.
Break the politics. There's a question here. I'm trying to weave in questions that have come up now. One is about the separation of commercial and investment banking under Glass-Steagall, and whether we've done enough, whether the Volcker rule's enough, whether there's anything left to be done here. What do you think about that?
My view on this, like many of my views, is not that popular. But I'll just be honest with you what I think. Let's go back and just think about what happened in this crisis. You had most of the failures that happened were people that existed on both sides of that line between commercial and investment banking. So Countrywide, IndyMac, WAMU, hundreds of commercial banks were mostly banks in the classic sense, took a huge amount of risk they didn't understand, deeply vulnerable. And then you had a bunch of pure standalone investment banks, Bear Stearns, mm-hmm, Lehman, that took a bunch of risks on the other side that they didn't understand, very vulnerable.
Right.
And there were institutions that straddled that line that were vulnerable too, but not really because they straddled that line.
Okay.
So. Mm-hmm.
You don't see the
I don't see the benefit. There's think about Canada. Canada's a system of universal banking. There's no Glass-Steagall separation. They let their banks do investment banking. It's a very stable system because it's much more conservatively governed. Mm-hmm. They force people to hold more equity in their homes against their borrowing, and in some ways it's easier to prevent runs. Mm-hmm. When a bunch of that finance is associated with banks. Because when it's outside of the bank, as we saw in our country, if it's in money market funds or investment banks or GE Capital, things like that, it's much harder to break the run.
Right. A player here that has not been raised so far, and one of the question raises, the rating companies. They played a role in this. So one of the things that absolutely was the case was that a lot of people believed, including really good financial minds, that you could put together a whole bunch of securities that were not that strong and end up with a composite security which kept getting AAA ratings. So do we, and my understanding is we really haven't changed the rating system. So we still have this issue. So what was the role of the rating agencies in all this, and do you think we should be doing more to deal with that part of the system? That's a question here.
It seems dark and unfair to say this, but there's nothing you can do about that, because they're going to be inherently vulnerable to the risk, like many investors are, many borrowers are, that they're going to attach too low a probability to the risk of a really bad house price out, which is what they did. You know, they just did a simple thing, which is to say, we think it's unlikely
so you don't
that
think
house prices would fall.
So you don't think it was because, so a lot of people say it's because of how they are paid. So their incentive structure is essentially they're being asked by the entities that are selling these assets to the public, they're being paid by them to give them good ratings. So
this is, there may be a little bit to that, and the SEC did do some reforms to reduce that conflict, but it wasn't the main source of the error and the miss. I mean, there's a really interesting academic paper on this, which I think helps a little bit. These guys at Princeton went around and they went and looked at the personal financial decisions in real estate of a bunch of insiders in the banking business at that time, mortgage business, because they were trying to test this proposition about whether these people were selling houses, meaning selling their own houses, meaning in effect shorting real estate.
Okay.
At the same time they were selling mortgages. And what they found was that those people were overwhelmingly buying the second house, buying a bigger house, getting more exposed, because they believed, like so many other people did, that this thing had some ways to go. They thought it was like the third inning, not the eighth inning. And that belief was very powerful, and it was systematic across the world. You know, people were desperate to buy these securities because they thought they were being compensated for the risk, and they were deeply mistaken. So you don't need to find a complicated incentive problem, even with all the bad behavior, to find the most powerful explanation about why these things they got so out of control.
But the profound evidence to me of the existence of mania was when everyone knew, the mortgage lenders knew, and the people putting these assets together knew that there was more and more subprime going to no doc, no income, no wealth. People would go online and basically create an employment document for themselves to get the mortgage. And nonetheless, people believed this was the level of jumping into mania. It didn't matter. Evidence didn't matter anymore. It just didn't matter. So it really. Let me ask.
Again, just to make it worse, all those attributes of those loans, without proof of income, proof of assets, proof of employment, it was accessible. It wasn't hidden.
No, it wasn't hidden. No.
These were securities issued in public markets.
Exactly.
You had to work at it to figure it out, but it was just, it's a terrible thing to say because it sounds like it's exculpatory, and there was, it was just terrible bad behavior too, and a lot of really dumb stuff too. But mostly what happened was this thing that Kindleberger called a mania.
So let's do a little bit of the bad behavior versus dumb stuff. Because another criticism, and there are a couple of questions that come to this, wasn't anybody responsible here? Why isn't any big name person in jail? And I think that's, and I know Sheila Bair takes this quite often. She'll say, we enlist the opportunity to take really bad people to jail, which would have been one of the deterrents to future bad behavior. So how do you respond to that?
I think it's a really good question, and I don't believe that. I think Americans deserved a tougher enforcement response than what they got. I think they absolutely deserved it, and I think most people believe that still. And I think it's understandable they believe that. I think you won't find it acceptable as an explanation, but the best way to understand this is to look at look at what people have written, who in trying to figure this out went and interviewed a bunch of prosecutors around the country.
Right.
Remember that we have lots of prosecutors in this country. We have a pretty powerful enforcement apparatus. And those people had the right incentives because, this was this is a calamity, massive devastation. And they had overwhelming pressure on them publicly and very powerful personal incentives to go figure out how to make people accountable. And they worked at it. And if you listen to what they said, it's not that reassuring, but they try to explain that what they found was that most of this stuff, overwhelmingly, that was really damaging, was dumb and greedy. You might even say venal. But you couldn't say it was illegal.
Yeah, not prosecutable. The prosecutors are looking at this saying, we won't win the case. We can't.
It's another way of saying it. Like we had a system which much of it was the Wild West. The rules weren't any good. So you had to fix the rules. You had to make the rules tighter and better, which we haven't made them perfect, but I think they're much tighter and better now, and hopefully that'll over time create a better enforcement deterrence.
So I'm going to turn.
Just to clarify, I didn't get to make those judgments.
No, you're not an enforcement. You're not an enforcement agency.
I would have liked to, but I didn't get to make those judgments.
Yeah, you're not enforcement. Let me turn a little bit. There are some questions here, and we don't have that much time left. To a very different role of the Treasury Secretary, which is, in normal circumstances, is the main role, and that's on fiscal policy. So you mentioned in passing that the stimulus was the right thing to do, perhaps too small, and then there was this too early turn to fiscal restraint. And then there was the debt limit crisis. So talk a little bit about you clearly were of the view that this was the wrong thing to do, that the fiscal restraint was too early, too big, was slowing the recovery down. Nonetheless, the president was out there saying the government has to tighten its belt, we have to put caps on discretionary spending, we have to negotiate a major grand bargain budget deal. What was your view on the appropriate fiscal stance?
Well, look, you're being nice. I wasn't a hero in this. I took the view that it was worth trying to see if we could negotiate a long-term set of reforms to entitlements and to the tax system that would be phased in gradually and give Americans more confidence that we were going to be able to live within our means.
Okay.
Because there was a deep concern across the country, and it was not just among Republicans, but Democrats too, that deficits were 10% of GDP, that it was deeply, it had huge political force, this concern about the fiscal side. And I thought that the best way to manage through that was to see if we could negotiate a set of well-designed, gradually phased in long-term reforms. And I thought if we were able to do that, it would give us more room in the near term for higher levels of infrastructure spending and things that could help make the economy stronger in the near term when we needed more demand. Okay. And I think that was the president's view too. He had no enthusiasm for a premature lurch to austerity. I mean, we tried it when we were doing our early strategy sessions with him. Larry and I used to remind him all the time that the mistake that Roosevelt had made and most governments make in financial crises is they put the brakes on,
too soon.
Fiscal brakes on too quickly. But we had a political system caught up in a bit of just premature fever of austerity, and we ended up with the worst balance. We lost the ability to do more infrastructure,
right,
more help to state and local governments too quickly, and that effort at long-term reforms ran against the deeply damaging political realities that people weren't ready to touch entitlements and didn't want to do anything on the tax side, really. And what we got is a bunch of premature, badly designed, very deep cuts in a small part of the budget, but large enough to sort of slow the growth momentum of the economy when it was too early and when Europe was really hurting us. So, if you just step back and say, what are the reasons why the crisis was so terrible and why the recovery was not as strong as many people would have liked, we let the fire burn too hot before we escalated, got too much momentum. And then we lost the ability to do more stimulus longer, and austerity came a little too quickly. That made the recovery weaker than it should have been, and those two things explain most of the avoidable damage. Some of the damage was unavoidable in this context.
Yeah. So one of the, as you know, Janet Yellen, who's now the chair of the Federal Reserve, and you were very significant in bringing her to the vice chairman role. She made, I think, right around when all of this was happening, had a really great speech sort of showing that in most post-World War II recoveries, the government was stimulating the economy in the several quarters after the recession. This time around, the federal government was actually contracting the economy, and so were all the state and local governments. So everything that was happening, the private sector was tightening its belt, and the public sector was tightening its belt, and that ends up to a very slow recovery.
And it's not just damaging in the immediate sense because it means that people are out of work much longer than is desirable. But these were the cuts that happened. I mean, we're in California, so you know better than me. We're in education and a bunch of things that have deep, lasting damage to the opportunity to give people in the future. And so it had two big, huge costs, and it was avoidable. These were avoidable mistakes, but we just in a little political system now where it was hard to.
Well, you did say it. I think you're being a little too hard on yourself, and I think a little too easy on the side you were negotiating with. So you say in the book that you kind of liked Boehner, but Boehner was really not able to deliver his party on this, and you do say one of the scariest things that happened in 2011 is we almost became very close to a default. And there was a general view on the Republican side that a default might be healthy for the economy. And you call it, this was essentially using the debt limit as a tool of extortion. There's a wonderful book, it's called It's Even Worse Than It Looks, where they call this tactic, and this is a Republican and a Democratic observer of Washington, both saying together that the Republicans were using the debt limit as a hostage-taking tactic. So I just want to say, we need everyone to understand what are the dangers to playing around with that debt limit, and what would be the cost to a U.S. default, because that hasn't gone away. It has gone away right now as an issue, but we haven't resolved it in terms of dealing with taking it out of hostage-taking possibilities in the future. So what are the risks?
There were two camps in the Republican Party about this. One was a camp that said, obviously default will be terrible, but we'll get him to blink. And what we'll do is force him to accept deep cuts in the safety net, things that we deeply believe are good for the country, and we'll just make him blink. Then there was another group of people who thought that, and their view was, it's worth trying. Maybe he wouldn't blink, or maybe he'll give us part of what we want, but that's a good strategy.
We'll give it a try.
And it'd be good for us. And there was another group who thought that actual default would be good because it would starve the government of the ability to make payments on a bunch of things that they think are bad for incentives, for make it less likely people would work, or go to the unworthy in some sense. And both those strategies took over the Republican Party for a while. But I think they've kind of, I think they didn't think it was that good for them. Mm-hmm. And I think they think it hurt them, like it hurt Gingrich.
Right.
And I think they've decided to disarm the weapon temporarily.
At least temporarily. At least temporarily. Yeah, that.
But it's worth reminding because the shock to consumer confidence and business confidence that happened around the debt limit mess in July of 11 was a larger shock to consumer confidence than what happens in the typical recession. It was very damaging at a time when the economy is still very weak, and obviously totally, completely avoidable.
So we're living in the hotbed of innovation, and we pride ourselves in California on being at the forefront of all innovation. Has the crisis and all of the reforms that have been put into place, which have correctly, I think, reined in risk-taking because it was excessive. But do you worry that it might deter innovation? So what kinds of innovation? I don't know. Bitcoin. There's a question here about Bitcoin. Or Bitcoin, I guess it is. Bitcoin. Yes, Bitcoin.
That was an unfortunate slip.
So what do you think? Have we taken too much risk out of the system, and are we discouraging financial market innovation like Bitcoin or something else that we can't even imagine right now? Or flash boys. The other thing would be, or this rapid trading. That's an innovation. That's a real innovation.
My sense is that if you're somebody with an idea in the United States, and you've got some plausible capacity to make that idea into a business, you have a better chance raising capital in this country on pretty attractive terms. That's true anywhere. And I think that basic strength of our system is very alive and well today, very strong. I think completely unaffected, frankly, by the fact that we've made banking much less economic.
A little more boring.
And maybe a little more boring for a while. So I think that I wouldn't worry about that. There's a lot to worry about in finance, but I wouldn't worry about that. What we did, again, however messy and imperfect, and it left a lot of challenges for the country still. We designed a strategy that was, as its objective was to make sure the system had enough capital that it could finance, that it could provide the oxygen you needed to an economy to grow again. And in our system, of course, we have this huge diversity of sources of capital still, even outside banks, that can help compensate for the maybe might be a little excessive risk aversion in parts of the system today. So something we should always be working at. You always want to create better incentives for innovation, and availability of finance is part of that. But I think we look pretty good on that measure. Again, not just against the standard of other countries, Germany, Japan, but against what existed in the decades before a crisis.
So I think we're largely out of time, and I went through the questions, and I think although we haven't done every one, I think we've captured the main issues. I want to end a little bit on a note about family, because this book is more than a book about financial crisis. It's about people and how they live their lives. And in many places, Tim talks about the sacrifice of having the job. So I would say his leadership, which I think has helped the country avert a Great Depression, it did cause hardship and pain for his family. And there's a wonderful story in the book about how he's lying there recovering from a kidney stone operation, and the president calls him up, but the president is identified in inner circles as the POTUS, and his daughter says, well, I'll just say, who the hell is the POTUS? She uses a little more colorful language. That's the same question my son asked when I was in government. The POTUS interferes with the personal lives of the people who work for him. So I want to thank you for your leadership, but I want to also thank your family for participating in the leadership. Jobs like yours are not individual jobs, they're family jobs.
Can I just say, that was really gracious of you, but I want to just put this in perspective for people. This is hard on families, but it's nothing like what families who have, relatives serve in the military go through, or police work, or fire stations, or first responders. There's nothing like that. I only talked about that because I was trying to write a book that at least provided some chance of giving people the ability to look at this mess we face through our eyes. Not because we'd expect people to agree with those choices, but I wanted to at least try to give people a better sense of what it was like to go through it. What were the choices we faced? They were very bad choices. What motivated those decisions, because they're so inexplicable still. And I thought the best way to do that was to try to write a bit more of a personal story. And for me, I loved my work. I felt so lucky in my work. I loved it. But it is true, and you know this, you went through this. Yep. These are consuming jobs. You want them to be consuming. But you lose your family. You lose time with your family. You deprive them of a lot of privacy. And so I did try to spice it up with a bit of stories about them.
Well, what comes across, I'll just go back to the point that we started with, which is a lot of this book is about who you really are. And who Timothy Geithner really is an extremely dedicated public servant. He's not a creature of Wall Street. He's a dedicated public servant who has spent his entire adult life and happened to be put in a position when of once in a lifetime, we hope doesn't happen again in our lifetimes, major crisis confronting the country. So thank you for our leadership. It's a great book. I really would say that if you want to have a sense of what was really happening, and in a very objective and dispassionate way. Thank you very much.
Thank you, Laura.
Thank you all for coming. Thank you and good night.
Thank you.
So good.
Thank you.